Welcome to the deep dive. You, our learner, wanted to get into Alpaca Finance, and that's exactly what we're tackling today. It's the biggest lending protocol for leveraged yield farming on both BNB Chain and Fantom. And what's really interesting right off the bat is it was a fair launch project. So, community owned, no VCs, no pre-mine.
Yeah, that fair launch aspect is definitely notable. It sets a different tone from the start.
For sure.
So for this deep dive, we've gathered info straight from the Alpaca Finance site. Their token stuff, how you can earn, the governance side.
Okay.
But we're also bringing in some broader context. We've got a Bank for International Settlements report looking at DeFi risks generally.
Yeah, the BIS view. Always interesting.
Yeah, and an Alpha Development report on how regulation is shaping up, plus a BlockSec audit that looks specifically at Alpaca's Delta-neutral vault security.
Got it. So our mission today is really to unpack the Alpaca token, its role, its mechanics within the platform, and then zoom out a bit, see how Alpaca fits into the whole DeFi world, the good and the risky parts.
Exactly. Context is key here.
Okay, let's dive right in then. The Alpaca token itself. What are its main jobs? What does it do?
Right. So the Alpaca token has a few core functions. Number one, it's about capturing the platform's economic benefits, value capture.
How does it do that?
Through performance fee sharing. So Alpaca Finance makes money from yield farming, liquidations, lending interest, their Alpi's NFTs, AUSD stability fees, those automated vaults, the Alpha Futures Exchange, AF 2.0 lending. Quite a list.
Okay.
And a slice of those fees gets distributed to folks who lock their Alpaca in the governance vault. Plus, there's a buyback and burn mechanism.
Buyback and burn. We see that a lot in crypto. What's Alpaca's thinking behind using that?
Well, the main goal is deflation, to potentially push the price up over time by reducing supply.
Makes sense. Scarcity.
Exactly. Alpaca has a hard cap, a fixed total supply, and the rate they release new tokens is designed to go down. At the same time, they're actively burning tokens.
How much are they burning?
Well, for instance, they take 80%, a big chunk of liquidation fees, and 10% of the interest earned by lenders on the platform.
Okay.
And use that to buy back Alpaca off the market and just remove it permanently. Their argument is that shrinking the supply can be better for token value than just handing out fees that people might immediately sell.
Right, so incentivizing holding and creating that scarcity pressure. You mentioned governance too. How does the token sit in there?
Governance is a huge piece. If you lock your Alpaca tokens in their governance vault, you don't just get a share of the revenue.
You get to vote.
You get voting power. You can vote on Alpaca improvement proposals, AIPs. Basically, it gives holders a real say in where the platform is heading, strategic decisions, new features, all that.
So locking up makes you a stakeholder. You get paid and you get influence.
That's the idea. And Alpaca has also mentioned they're planning things like exclusive earning opportunities, maybe even special NFT access with utility, specifically for Alpaca holders down the line.
Interesting. Always good to have things on the roadmap. Okay, let's get into the Alapanomics, the token distribution, the supply numbers. What are the key details there?
So total supply, as I said, capped at 188 million Alpaca. And that fair launch thing is really central to the distribution.
How so?
A massive 87% of all tokens were allocated directly to platform users, people actually using the protocol.
Wow, 87%. That's high.
It is. Less than 9% went to the team, and that's vesting over 2 years with emissions decreasing over time.
Okay.
There's also a development fund, 8.7%, same 2-year vesting schedule. It really shows that commitment to community ownership.
But does that have downsides, like slower decisions maybe?
That can be the trade-off, yeah. Compared to, say, a VC-backed project with more centralized control, community governance can sometimes take longer to reach consensus. It's part of the fair launch model.
Fair point. Any other significant pots of tokens?
Yes, there's what they call a war chest. That's 8 million tokens set aside for strategic stuff, paying for exchange listings, security audits, partnerships, things like that.
Makes sense.
And to keep things steady, they can only pull out a max of 200,000 tokens per month from that war chest, unless, of course, the community votes to approve a larger withdrawal for something specific.
So community oversight even on the war chest spending.
Right. Oh, and one recent thing to note, they stopped the token bridge between BNB Chain and Fantom. That was because the underlying platform, multi-chain, shut down. So, something to be aware of.
Good practical point. And those AIPs, the improvement proposals, what kind of things has the community actually voted on?
Oh, a real mix of critical stuff.
Yeah.
Our sources showed votes on migrating from their original system, AF 1.0. It's the newer. AF 2.0, that was a big one. Involved isolated lending pairs, better risk controls.
Okay.
Also things like setting marketing budgets, figuring out how to handle bad debt, which can happen in lending.
Yeah, definitely.
Tweaking the interest rate models, proposing totally new products like potentially their own stablecoin, and even upgrades to how the governance vault itself works.
It sounds like a very active governance process then.
It really does. The sheer number and variety of AIPs suggests the community is, pretty engaged in steering the ship.
So if I'm holding Alpaca and I want to get involved, cast my vote. What's the process? How do I do it?
It's pretty straightforward, actually. You need to take your Alpaca tokens and deposit them, lock them up in the specific governance vault on their platform.
Okay, lock them up.
Once they're locked, you're eligible for those platform fee rewards we talked about, and critically, you get the ability to vote on active AIPs.
And can you get your tokens back out if you need them?
There are options for early withdrawal, yeah, but usually there's some kind of penalty involved if you pull them out before the lockup period ends.
Right, encourages longer-term commitment. Okay, so Alpaca, the token, is clearly vital. Let's widen the lens now to the whole Alpaca Finance ecosystem. What else do they offer besides the token and governance?
They've built out quite a suite of DeFi services. There's the basic lending platform, of course, then leveraged yield farming, both the original AF 1.0 and the updated AF 2.0.
Right.
They also have automated vaults that run specific strategies for you. There's Alperp, which is their perpetual futures exchange, and the Alpies NFTs we mentioned, which might get more utility later.
Okay, a lot going on. Their website talks about 6 simple strategies to earn. Can you give us the quick rundown on those?
Sure. Strategy 1 is lend and stake. They frame this as lower risk, just earning yield by lending your crypto.
Simple enough.
2 is hold a token pair for auto-compounded yields. This is earning yield on a pair, like in a liquidity pool, but without using leverage.
Okay, passive income style.
Sort of. 3 is supercharge stablecoin yields. This involves using leverage up to 6x, specifically on stablecoins. They position this as low risk because, well, stables don't have impermanent loss like volatile pairs.
Interesting angle. What about for more volatile assets?
That's strategy 4. Multiply crypto gains in a bull market. Basically, taking long leverage positions. You borrow stable coins usually, or maybe the less bullish coin in a pair, to long the one you think will go up.
Okay, classic leverage play. And for down markets?
Strategy 5. Yield farm profitably in a bear market. This is the opposite, taking short leveraged positions. You borrow the asset you expect to drop in price.
Got it. Longs and shorts.
And finally, strategy 6 is about trying to multiply crypto gains in any market by hedging. This involves combining long and short leverage positions, maybe trying to capture funding rates or other opportunities while aiming to be market neutral.
So a strategy for pretty much every market view and risk appetite, it sounds like.
That seems to be the goal, yeah.
Now, whenever you talk about lending and especially leverage in DeFi, security alarms start ringing for people. What has Alpaca done to address security concerns?
Yeah, it's absolutely crucial. They point to multiple independent security audits they've undergone. That includes the BlockSec audit we looked at, which specifically dug into their Delta neutral vault.
Did that audit find issues?
It did identify some potential high-risk vulnerabilities, which Alpaca says they addressed. Security is an ongoing process, right?
True.
They also highlight getting a top safety score on BNB Chain from DeFi Safety back in mid-2021, and a high ranking from Certic around then, too. For ongoing protection, they use Chainlink oracles for reliable price data.
Important.
And they have their own system called Alpaca Guard. This is designed to protect against flash loan attacks, sudden weird liquidations, and price manipulation attempts.
Alpaca Guard. Okay.
And on top of that, for users who want extra peace of mind, they offer the option to buy insurance coverage through Nexus Mutual.
So multiple layers of defense. That BlockSec audit mentioned the Delta neutral vault. What exactly is that trying to achieve?
Right. The Delta neutral vault is a more complex strategy. The idea is to hold both a long and a short position on the same underlying crypto asset at the same time.
Long and short simultaneously. Why?
The goal is to neutralize the effect of the asset's price going up or down, to make your overall position delta neutral.
So you don't care if the price crashes or moons?
Ideally, yeah. The aim is to generate returns primarily from the yield farming rewards you get from holding those leveraged positions or from funding rates, rather than betting on price direction, trying to isolate yield from volatility.
That's a fascinating concept, isolating yield. Okay, let's pivot now. We need to talk about the wider DeFi space and the risks involved. The Bank for International Settlements report had some strong views, didn't it?
It did. The BIS offers a, let's say, cautious perspective, they acknowledge DeFi aims to cut out middlemen using automated protocols and stablecoins.
Right.
But they talk about the decentralization illusion. They argue that in reality, you often still need some form of centralized governance for big decisions. Yeah. And the way blockchains work, especially consensus mechanisms like proof of stake, can actually concentrate power with a few large players or validators. So maybe not as purely decentralized as the name implies.
That's a really important point, the decentralization illusion. What other vulnerabilities did the BIS flag in DeFi?
Several key ones. High leverage is a big one. It amplifies everything, both gains and losses, and can make markets more volatile, especially during downturns. They call it procyclicality.
Okay, leverage risk.
Then there are liquidity mismatches. This is a major concern for stablecoins. If everyone rushes for the exit at once, can they actually redeem their stablecoins for the underlying assets? It's a classic run risk. The interconnectedness of DeFi is another factor. Protocols rely on each other for liquidity, collateral, price data. So if one part fails, the problem can spread really quickly through the system. Contagion risk.
Like dominoes falling.
Exactly. And finally, the BIS points out the lack of traditional safety nets. There's no FDIC-like deposit insurance in DeFi, no central bank acting as a lender of last resort, fewer shock absorbers when things go wrong.
Those are definitely systemic level concerns. What about DeFi governance itself? Does the BIS see that as part of the problem or solution?
It's kind of both. They recognize that governance, usually through token holders voting on proposals like Alpaca's AIPs, is necessary for platforms to evolve and make decisions. DAOs are even getting legal recognition in some places.
Right.
But they also worry about power concentration within that governance.
Right.
Especially in proof-of-stake systems, large token holders can dominate voting, potentially leading to collusion, wash trading, or front-running other users' trades.
So governance itself can have centralization risks.
Potentially, yes. It's a challenge.
And stablecoins seem to be a recurring theme of concern for the BIS.
Absolutely. They're so fundamental to DeFi, but the BIS highlights their potential fragility. It all comes down to the reserves backing the stablecoin.
What kind of issues?
Well, risk mismatches. If a stablecoin is backed by something less liquid, like commercial paper, can they sell it quickly enough in a crisis? If it's backed by volatile crypto, what happens if the collateral crashes? There's also maturity mismatch potential. And crucially, unlike bank deposits, there's generally no public backstop, no government guarantee if a major stablecoin fails.
Lots to think about with stablecoins. Okay, let's shift to regulation. How are governments around the world actually trying to handle DeFi? The Alpha Development Report looked into this, right?
It did. And the big picture from that March 2023 report is, well, it's complicated and varies a lot globally. It's still very much an evolving landscape.
Let's start with the U.S. What's the situation there?
The U.S. is often described as having regulatory uncertainty. The SEC, the Securities and Exchange Commission, has been pretty active with what some call regulation by enforcement, suing projects they deem unregistered securities.
Right.
FinCENA, which deals with financial crime, has proposed AML/KYC rules, but there isn't overarching DeFi legislation from Congress yet. The CFTC, the commodities regulator, is also involved, saying things like Bitcoin, Ether, and some stablecoins are commodities under their jurisdiction. So it's a bit fragmented.
Fragmented and enforcement-led. Okay. What about the European Union? Are they taking a different path?
Yeah, the EU seems to be aiming for a more unified, comprehensive framework. GDPR, the data privacy law, applies. ESMA, the Securities Authority, has guidance on crypto products.
And MiCA. We hear a lot about MiCA.
Exactly. The Markets in Crypto Assets Regulation, MiCA, is the big one. It aims to create consistent rules across the EU for all crypto assets, including DeFi tokens, and distinguish between different types like security tokens and utility tokens. The ECB, the European Central Bank, is also pushing for global coordination on stablecoin rules.
So the EU is trying to build a clearer rulebook. How does Asia-Pacific compare?
Asia-Pacific is really diverse. You've got Singapore, which is seen as quite crypto-friendly. They have clear rules for registration, AML, KYC, and government projects like Project Guardian exploring DeFi use cases within regulatory sandboxes. Then you have mainland China, which has banned crypto trading outright, though there's always talk about potential shifts. Hong Kong is moving in the opposite direction, actually legalizing crypto trading under new rules. And Japan has a licensing system for exchanges and has been tightening rules around things like withdrawals. So a real mix.
A total spectrum. What about other regions like the Middle East, Africa, Latin America?
Similar diversity, really. In the Middle East and North Africa, you see places like Nigeria initially banning crypto, but now rethinking it, alongside places like Dubai and the UAE, actively trying to attract crypto businesses.
Right.
The Central African Republic even adopted Bitcoin as legal tender, though the practicalities are complex. And in Latin America, you have El Salvador, also with Bitcoin as legal tender, representing a very permissive extreme. Mexico is developing its framework, while Brazil has been seen as relatively progressive in adopting crypto and creating laws around it.
It really highlights how difficult it must be for regulators worldwide, trying to keep up with this fast-moving global technology while balancing innovation and protection.
That's the core challenge, isn't it? The overall trend is definitely towards more regulation, more scrutiny, but the key will be creating rules that are smart, flexible enough to adapt, and effective at managing the real risks without stifling potentially useful innovation.
This has been incredibly thorough. We've gone deep into Alpaca Finance, its token, its strategies, and then zoomed out to the wider DeFi context, the risks, the regulations. To wrap things up, what are the absolute key takeaways for you, our learner?
Okay, I think first, regarding Alpaca itself, the Alpaca token is really the heart of the platform. It's not just about earning rewards through fee sharing. It's also your key to having a voice in governance. Understanding how that token works, its supply mechanics, and the different ways to earn on the platform, that's your starting point for engaging with Alpaca Finance.
Got it. Token utility and platform engagement. What about the bigger picture?
The bigger picture is that DeFi, while full of potential things like more open access to financial tools, comes with significant inherent risks. We talk about leverage, stablecoin stability, interconnectedness. These aren't trivial concerns.
Right.
And because of those risks, regulators globally are stepping in. That regulatory landscape is complex and evolving fast, but it's moving towards more oversight. And finally, remember that decentralization illusion idea from the BIS. Even in DeFi, you need to look closely at where power actually lies, how decisions are made. It's often not as purely distributed as it might seem at first glance.
Really crucial points to keep front of mind. This deep dive gives a snapshot, but this space changes so quickly. We definitely encourage you to explore the sources we mentioned, check out the Alpaca docs, read those BIS and alpha development reports if you want the full detail on risks and regulation. Keep learning.
Absolutely. And maybe that leads to a final thought, a question for you to ponder. As DeFi continues to evolve alongside regulation, what specific part of this evolution grabs your curiosity the most? Is it how governance models might change? The future design and regulation of stablecoins, or perhaps how DeFi and traditional finance might increasingly intersect or collide? There's no shortage of fascinating questions ahead.
A great question to end on. Thanks for joining us for this deep dive.